Index funds are one of the most popular products in the world of investing today. Warren Buffett himself said that it's the easiest way for the average investor to make consistent returns. When a legendary billionaire investor says something, I think you want to pay attention.
In this video, we're going to tell you about a simple index investing strategy that has made people millions over the years. So make sure to stick around to the end. Hi everyone and welcome to another video. I'm Aishwarya and this is Arjun. And on this channel, we share our stories and tips about personal finance and investing as internationals in the US. So if you're someone who wants to understand how to make better use of your money to become financially free, hit the red subscribe button and the notification bell next to it so you don't miss out on our future videos.
Alright, today we're going to tell you all you need to know about index funds. You've likely already heard about them and how they've become the titans of Wall Street in the last decade or so. Terms like low cost, diversification, and low effort are often associated with these funds. We'll get into all of those details, but before that, let's clear up some terminology. And by that, I mean the difference between an index fund, a mutual fund, and an ETF. When I first started out investing, this was something that was really confusing to me, so I think it's best to start here.
In our previous video, we introduced the concept of buying and selling individual stocks on the market. But funds are structured a bit differently. Let's say that this box is a mutual fund. It will have a collection of assets like stocks and bonds. This box is managed by an investment company on behalf of investors who don't have the time to do it themselves.
Now, if this is an actively managed mutual fund, it means that there's a dedicated portfolio manager whose job it is to pick individual stocks that would perform best for this box. They essentially try to beat the performance of the market.
On the other hand, an index fund aims to match the performance of a particular index, like the S&P 500. So for example, if this box is the S&P 500 index, our fund will put in and take out exactly what this index does. And it will also experience highs and lows along with the market performance.
Index funds can be structured as mutual funds like we just described, or as ETFs. If it's structured as a mutual fund, then you can buy and sell shares only once a day based on that day's closing price. Here, you're doing business with the company that owns the fund. If it's structured as an ETF, then it's listed on the exchange and you can buy and sell throughout the day. Here, you're doing business with other investors and not with the company.
So why does everyone love index funds so much? Firstly, it minimizes risk through diversification. Let's say that there are 10 popular companies in a particular sector. You have $10,000 to invest and you put all of it in one company. Now suddenly, this goes down by 50% and you've lost $5,000. If you had spread out your investments and put $1,000 in each of those 10 companies, you would have lost out on only $500. But if you had bet everything in one stock and it went up by 50%, then you would have gained only $500 compared to $5,000. It's a delicate game, which is why we like to strategize by putting 80% in index funds and keep 20% of fund money for individual stocks. This way, a bulk of our money is in well-established and less volatile investments, but we still have some money to experiment with as well.
Another reason why we have majority of our funds in an index fund is because it tends to outperform most actively managed funds in the long run. Remember, these active fund managers are Ivy League graduates who buy and sell stocks day in and day out for a living. If they can't seem to beat the index, imagine how hard it would be for average Joes like you or me. To prove this, Warren Buffett bet the actively managed fund industry $1 million that they couldn't outperform the S&P 500 index over a period of 10 years. One brave firm accepted. I think you know where we're going with this, but Buffett won the $1 million and donated it entirely to charity.
The third point to consider is that active management has higher expenses associated with it. So over time, you'll end up paying a lot in fees. Since index funds are passively managed, they have the lowest fees in the game. They're also tax efficient because there's less buying and selling going on.
Okay, so let's say we did a great job in convincing you about index funds. How and where do you actually start? The first step is to choose a brokerage through which you want to invest with. The three most popular ones that offer index funds for a low cost are Fidelity, Charles Schwab, and Vanguard. If you're on a US visa, you should be able to open any one of these accounts, but just note that some people have found it difficult opening a Vanguard account, especially on an F1 visa.
Next, you have to decide which account you want to use to buy these funds. Is it your 401k, Roth IRA, or just a regular taxable brokerage account? Now, I know this can be confusing, especially if you're new to investing, so maybe we can make a separate video about it some other time.
Now for the fun part where you get to pick and choose the funds you want to buy. How do you know what a good index is? There are a couple of things to look out for. Does it have enough securities to represent a broad market? You don't want an index fund that has only a handful of stocks that you can count on your fingers. It should represent a good portion of the economy. Is the index transparent, meaning do you know exactly what assets are included? Now, for the fund itself, the most important number to look at is the expense ratio. This is the percentage of your investment that the company charges as commission. For example, if you've invested $10,000 and the expense ratio is 0.1%, this means you'd pay $10 in fees. The next thing to check is if there's a minimum investment. For example, some of Vanguard's funds require a minimum of $3,000 just to buy in. If you don't have this kind of money upfront, this is where an ETF is a good option. They basically track the same index, so you'll have similar returns, just in a different structure.
Now, if you made it this far, you get to hear about a beautiful investment strategy that's both simple and effective. It's called the 3-fund portfolio. But first, take a 3-second break to hit that like button for the YouTube algorithm.
Actually, it only takes 1 second.
I know, but I did it for the joke. Okay, the 3-fund portfolio. This is an investment strategy where your entire portfolio has only 3 low-cost funds. A domestic total market fund, which in our case is the US, an international total market fund, and a bond total market fund.
Deciding the percentage split between each of these funds is referred to as your asset allocation. The most common way to set up this portfolio is an 80-20 split between stocks and bonds, with a higher percentage weightage towards US stocks. This would mean 64% in US stocks, 16% in international stocks, and 20% in bonds. The older you get, the more you want to increase your bond allocation.
We really like Vanguard. So from their list of core funds, the ones that are best for a 3-fund portfolio are VT-SAX, VT-IAX, and VBTLX. If your account is set up with other companies like Fidelity or Schwab, then check out bogleheads.org for specific investments for your 3-fund portfolio. Fidelity introduced funds with 0% expense ratio last year, which is actually the first in the industry.
By investing in an index fund, you check all the boxes that a good investment should have. Good returns.
Yes.
Low costs.
Yes.
Diversification.
Yes.
Low effort.
Hell yeah.
Researching and picking individual stocks successfully is difficult even for the pros. So index funds are the way to go for most investors. If you're patient, you can expect to see exceptional returns, especially when compounded over multiple years.
So that's it for today's video. We hope you enjoyed it. If you have any comments or questions, let us know in the section below and we'll do our best to help out. Thank you so much for watching and we'll see you next week.